Welcome to the deep dive. You brought us quite a mix of sources today: finance texts, urban planning history, investment guides, tax code sections, and our mission, it seems, is pretty clear. Finding that hidden value in real estate, getting ahead of the curve before everyone else piles in. We're trying to give you that shortcut to being genuinely informed.
Yeah, because lots of folks, they try to spot the next hot neighborhood by counting coffee shops or seeing where the yoga studios are opening up. But those are just, well, they're symptoms, aren't they? Not the real drivers. So this deep dive, we're going past that surface stuff. We're digging into the actual data, the big historical currents, the financial machinery that, really makes revitalization happen and drives up asset prices.
Exactly. We really need to step back from just anecdotes.
Yeah.
And apply some critical thinking, because that's what you need for high-stakes investing. We're not just going to talk about what properties look good, but the fundamental why. It's about connecting those big investment ideas, the science of how cities work, and smart tax strategies. So when you do spot that opportunity, you really grasp its potential and know how to actually act on it.
Okay, that's quite the roadmap. So we're kicking off with the basics, the fundamental laws of risk and how markets behave. Then we'll get into how cities actually grow, the history and the modern forces shaping where people and money cluster. After that, we'll unpack some specific investment systems like BRRR, 1031 exchanges, that sort of thing. And finally, we'll cover that other context, the required impartial reporting from the broader sources you brought.
Right. Let's ground ourselves first. The absolute bedrock principle in finance, doesn't matter if it's stocks, bonds, or a duplex, is this. Risk and reward are, well, they're joined at the hip. It's immutable. The only way you get higher potential investment rewards is by taking on more risk. Critically, though, you only get rewarded for the kind of risk you can't just diversify away.
Right. Not for just picking one stock versus the whole market.
Exactly. You only earn that higher average return over the long haul if you increase the portfolio's systemic risk, the stuff diversification can't eliminate. And this isn't just theory. It's backed up by, centuries of data.
And we see that really clearly in the long-term numbers, don't we? You look at that data from, 1926 to 2018, common stocks on average gave pretty generous total returns as dividends and price growth combined. Way better than long-term bonds or T-bills or just, keeping up with inflation.
Mm-hmm. And understanding that is key. Equities, whether that's public stocks or, owning rental properties, they've historically offered a positive real return after you account for inflation. So they've been much better inflation hedges long-term than fixed income stuff like bonds. But, and this is the crucial but, that extra return comes with volatility, variability.
Yeah, big swings.
Huge swings. Stock returns in that period, they went from a 50% gain in one year to some really scary losses in others. That variability, that's the risk. That's what you're supposedly getting paid to endure over time.
Okay, so how does this connect to actually valuing a property? I mean, we hear about price to earnings ratios for stocks, but there's a parallel in real estate with cap rates, isn't there? How does all that market psychology and maybe more importantly, interest rates affect what someone's willing to pay for, say, rental income?
That relationship is absolutely critical. Think about it. When interest rates are super low, what happens? Bonds, CDs, they offer terrible returns.
Yeah, practically nothing sometimes.
Exactly. So suddenly a stock or maybe a rental property that only yields a fairly low cash flow percentage-wise, it starts looking pretty attractive. Why? Because it's competing for your savings dollars against those lousy bond yields. Investors just don't have many good alternatives, so they're willing to pay more today for those future earnings or rent checks. The price gets bid up. Now, flip it. What happens when interest rates are high? Those future cash flows, whether it's dividends or rent, they have to be discounted back to today's value using a much higher rate. That drastically lowers the present value, the price someone's willing to pay now. It's why back in, say, 1982, when rates were sky high and everyone was pessimistic, stocks were dirt cheap. PE ratios were down at 8 times earnings. You could buy assets for pennies on the dollar.
Wow, 8 times earnings.
Yeah. But then you have other times, maybe rates are near zero, optimism is through the roof, and you see PE multiples over 80. So understanding this inverse dance between interest rates and valuation multiples, whether PE for stocks or cap rates for real estate, it's absolutely essential if you want to figure out if something is truly cheap or expensive.
Which leads right into that behavioral finance trap, doesn't it?
Yeah.
The herd mentality. If super low rates have already pushed prices, whether stock PEs or property cap rates, to historic highs, well, you're probably already late to the party.
That's precisely the selection penalty phenomenon. History shows us time and time again, average investors tend to chase performance. They dump money into whatever mutual fund did great last year. Remember the tech boom in early 2000? Everyone piled into those growth funds.
Oh yeah, right before the crash.
Right before they cratered. Meanwhile, the boring, unloved value funds that everyone ignored, they often quietly chugged along or even did okay.
So the takeaway for you, the listener, it sounds simple, but it's incredibly hard to actually do. If everyone is buzzing about a certain neighborhood or a specific type of investment or some hot new strategy, you should probably be very, very cautious. That excitement is likely already baked into the price, your potential upside, and your margin for safety has shrunk a lot.
Couldn't have said it better. And the way you fight that herd instinct is with discipline, with risk mitigation systems. We mentioned things like dollar cost averaging and rebalancing. Now, those terms come from stocks, but the principles apply just as much to real estate.
Okay, let's unpack that translation. Dollar cost averaging. How does that work when you're buying, a whole house, not just shares every month?
Good question. In real estate, it's less about buying the exact same dollar amount regularly and more about phased investment in a market you like. So instead of throwing all your capital into one deal right now, maybe you aim to buy, say, 3 properties in that target area over 3 years.
Spreading it out over time.
Exactly. You average out your entry price point. You protect yourself from accidentally buying everything right at the absolute peak of the market. It's about methodical capital deployment, reducing that timing risk. And rebalancing. I'd argue that's even more crucial for real estate investors. Let's say you own 4 rental properties. One of them, maybe in a gentrifying area, has shot up 200% in value in just a few years. Amazing, right? But another one, maybe in a slower town, is just kind of limping along. Rebalancing means you systematically sell that high-flying property, maybe using a 1031 exchange, which we'll get to, and you take that equity and reinvest it. Maybe you buy another property in a less inflated area or pay down debt on the others, whatever brings your overall portfolio back towards your target risk level. You're essentially forcing yourself to sell high and buy low within your own holdings.
That makes a lot of sense systemically. But it really hinges on the investor truly understanding their own tolerance for risk, doesn't it? And you make a key distinction in the source material between your attitude towards risk and your capacity for it.
That distinction is absolutely paramount. Your attitude is, well, it's emotional, subjective. It's how comfortable you feel about potential losses, whether you can sleep at night. Your capacity, though, that's cold, hard, objective finance. It's your actual financial ability to withstand losses without derailing your essential long-term goals, like retirement.
So you might feel like a risk taker.
Right. You might feel totally fine leveraging up to buy 5 fixer-uppers using the BRRRR method.
Right.
But if you're 5 years from retirement and a market downturn could wipe out your equity, your capacity for that risk is actually very low, regardless of your gung-ho attitude. A smart investor knows their capacity limit and builds their strategy so they never cross it.
Okay, so we have the financial guardrails in place. Now let's pivot to the physical world. If you want to find undervalued real estate that's actually poised to grow, you really have to understand what drives urban value. And that story, it seems, goes way back almost 2 centuries, looking at how technology basically reshaped where people live and work.
That's exactly right. If you look back between about 1815 and 1875, American cities went through this incredible spatial shift. It was really driven by what's called the transportation revolution. You had new things like steam ferries, horse-drawn omnibuses, and then, crucially, the first commuter railroads. These things dramatically cut down the friction of distance. Before that, pretty much everyone had to live close enough to walk to their job. These new options gave people, especially the wealthier ones, choices.
And those choices had huge consequences for the shape of the city.
Massive. It actually led to an inversion of the previous pattern. It kicked off this trend of suburban affluence and simultaneously center city decline, or despair, as the sources put it. All of a sudden, people with money could afford the daily train fare and the time it took to commute. They could escape the smog, the noise, the disease of the industrial core. The suburbs, which used to be seen as sort of backwards or rural, they became the desirable places to live. And the city centers, they were increasingly left to factories and the working poor. It created blight.
It's interesting how some of those early technologies were clever mixes of old and new. Your sources point to the horse car as a really good example of bridging that gap.
Yeah, the horse car is fascinating. It perfectly illustrates that transition. It took the low cost and the stop-start flexibility of using a horse, but combined it with the efficiency, the smoothness, and importantly, the all-weather reliability of running on a dedicated rail line.
Right, no getting stuck in the mud.
Exactly. It wasn't super fast like a steam train, but it was cheap and reliable enough that it made daily commuting feasible for, say, the middle class, allowing them to live maybe 2, 3, even 4 miles out from the downtown jobs. This physical separation of where people live from where they work, it was intentional, and for a very long time it seemed like an irreversible trend.
Okay, so flash forward 150 years or so. Now we're seeing signs of what people are calling the great inversion. That pattern is starting to flip, isn't it? The big move away from density that characterized, say, the 1950s and 60s is now becoming a move away from low-density suburban sprawl. People are moving back in.
Yes, this reversal is happening, and it's powered by a really potent economic force: clustering. You look at today's superstar cities, New York, San Francisco, London, Boston, they thrive because firms and whole industries cluster together physically, finance in Manhattan, tech in Silicon Valley, and so on. But actually, the real engine, the deeper magic, is the clustering of talented, ambitious people.
That feels like the crucial difference, not just companies, but human capital.
Precisely. When you pack lots of smart, driven people together in one place, you get what economists call human capital externalities. Basically, good things happen faster. Serendipitous meetings occur, ideas cross-pollinate, knowledge transfers almost instantly, new opportunities pop up constantly. It makes the dense urban core incredibly productive and therefore incredibly desirable, especially for knowledge workers.
So the dynamic flips.
Completely. The 21st century downtowns and inner-ring neighborhoods are increasingly where people with money and options choose to live. They want that density, that energy, and they can afford the price premium it commands. And folks living further out on the periphery, increasingly, they're there not out of choice, but because the prices in the desirable core have pushed them out. It's the exact opposite of the post-World War II suburban dream.
Okay, so if you, the listener, are trying to spot the next area where this clustering force is about to take hold, where that human capital is starting to pool, you need some ground-level indicators. And for that, you bring in the legendary urban observer, Jane Jacobs. What physical clues did she say we should look for? What makes a neighborhood truly alive and vibrant?
Jacobs's core idea was that real neighborhood vitality comes from conditions that generate what she called intricate cross-use. That's a fancy way of saying you need lots of different people on the streets for different reasons at all different times of the day and night. This creates natural eyes on the street, making it safer and more interesting. You're looking for a place where the ecosystem of daily life is varied and self-reinforcing.
Okay, let's break down her famous 4 conditions, but think about how they actually interact. What are the signs of this intricate cross-use we should be scouting for?
All right, first, and maybe most crucial, is mixed primary uses. You need residential buildings, shops, offices, maybe even some light workshops or studios all jumbled together, not separated into rigid zones like in many suburbs. Why? Because different uses bring people out at different times. Offices are busy during the day, residential areas at night, shops on weekends. If it's just offices, the place is a ghost town after 5 p.m. If it's only houses, it's dead from 9 to 5.
Which connects directly to our 4th point, right? The balance of activity across different times, day, night, weekend. You need residents living near the businesses so there's always someone around. If a place only feels alive during the weekday lunch hour, it's not a truly vital Jacobsian neighborhood. It's probably just a business district that's going to feel deserted later.
Exactly. The second key ingredient is frequent streets and short blocks. Jacobs argued that streets aren't the destination, they're the means for interaction. Short blocks mean more corners, more potential routes, more chances for casual encounters, or just observing street life. They make the area more permeable. Long, straight super blocks with few intersections. They kill that local vibrancy.
So if you see a city actively breaking up long blocks, maybe adding pedestrian cut-throughs or investing in traffic calming that encourages walking and makes streets feel more frequent, that's a good sign. It's like they're setting the stage geometrically for that human interaction.
Precisely. And the third indicator she identified is often overlooked but vital: buildings of various ages and conditions. This is absolutely critical for economic diversity. Why? Because older, maybe slightly run-down buildings offer cheaper rent. that allows small independent shops, little cafes, artists, tech startups, the very things that bring character and life to actually afford to be there. If every single building is brand new and shiny, only the big national chains and major corporations can pay the rent, and that homogenizes the area, killing the intricate cross-use.
That's really interesting. So the most promising block might not be the one with the single giant new luxury condo building, but maybe the one where that new condo sits next to a slightly shabby 100-year-old duplex, across from an old warehouse that someone's turning into a microbrewery.
Yes, that mix, that variety in building stock, it allows for a mix of people and businesses. And this leads to Jacobs's important warning about density. She argued you need concentrated density to achieve that vibrant street life and diversity, especially in areas that might be struggling economically. Those in-between densities, denser than a suburb but not dense enough to support lots of shops and constant activity, she felt those were often the worst. They lack the amenities and the natural surveillance of truly dense places. So you want to look for areas where density isn't just allowed, but actively being encouraged or pursued through zoning and development.
All right, we've laid out the financial realities of risk and this sort of urban planning blueprint for value. Now comes the hard part, execution. How do you take these big ideas and turn them into a practical, repeatable way to invest successfully? This seems to require a real shift in thinking less about goals, more about the systems you follow.
This might be the biggest mental shift an investor needs to make. The sources really hammer this point home. Your results, long-term, have surprisingly little to do with the goals you set, like, I want to be a millionaire. They have almost everything to do with the daily or weekly processes you stick to. The saying goes, you don't rise to the level of your goals, you fall to the level of your systems. We need to obsess less about the destination and more about the navigation, the specific, repeatable steps we take consistently.
Which sounds exactly like the idea behind Atomic Habits, right? Making these small, consistent changes that are part of a bigger, deliberate method. And the BRRR strategy seems like the perfect real estate example of this. Very defined, repeatable system designed for scaling wealth through leverage.
Absolutely. BRRRR stands for buy, rehab, rent, refinance, repeat. The concept is elegant, really. You aim to buy a property significantly below market value, usually because it needs a lot of work. Then you rehab it effectively to force appreciation, increasing its value. Next, you rent it out to a tenant to establish income. Then comes the crucial step. You refinance the property based on its new, higher appraised value, ideally pulling most or all of your original invested capital back out in cash. And finally, you repeat the process with that same capital on the next deal.
It sounds powerful, but success seems to absolutely depend on getting two key numbers right from the start. You have to accurately predict the comps, what the property will be worth after you fix it up, the asset repair value or ARV, and you must nail the rehab budget. If you mess up either of those,
you're in trouble. Yeah, getting those wrong can instantly turn what looked like a home run into a deal where your capital gets trapped, or worse, you lose money. And that highlights the main risks you have to manage with BRRRR. First is what you could call appraisal risk. You do all the work, spend 6 months rehabbing, looks great, but then the bank's appraiser comes out for the refinance, and maybe the market softens slightly, or they just don't see the value you saw. The appraisal comes in lower than you needed. Suddenly, you can't pull all your cash back out. Your repeat step is stalled. The second big one is construction risk. Let's face it, renovating properties, especially older ones you buy cheap, is tricky. Unexpected problems pop up, hidden plumbing issues, foundation cracks, outdated electrical. Your $50,000 rehab budget can easily balloon to $70,000 or $80,000 if you're not careful or unlucky. That eats directly into your profit and, again, reduces how much cash you can pull out in the refi. A solid BRRR system must include robust contingency funds for these unknowns.
So let's make this concrete.
Yeah.
You mentioned that example of the investor in California back around 2013. They used BRRR successfully, but they had to go out of state to do it. What was it about their system that forced that decision?
Right. That investor had a clear system with strict rules. Rule 1 might have been, I only buy properties where I can achieve at least $6 amount of forced appreciation. Rule 2, the property must cash flow by Y amount after refinancing. By 2013, the California market had bounced back so much that finding deals meeting those criteria, say buying at 75 cents on the dollar, was almost impossible. Prices were too high. So the system didn't say buy in California, it said buy where the numbers work.
Ah, the system dictated the geography.
Exactly. So they took their proven BRRRR checklist and applied it to markets like Arizona, where the recovery was lagging, and those discounted cash flowing deals still existed. They followed the system, not a specific location preference, and built their portfolio that way.
That really drives home the power of process over preference. Now, thinking about that rehab phase, if the name of the game is spending the least money for the biggest value bump, high ROI improvements, what are some specific atomic habits of renovation we should focus on?
You want to hit the things that have a big sensory or emotional impact. Take showers, for instance. A really nice, modern-looking shower can make a huge impression on a buyer or a renter. They walk in, see beautiful tile, maybe a rainfall shower head, high-end fixtures. They immediately feel the quality and anchor their perception of the whole property's value right there. But here's the thing. Most shower stalls aren't that large in area, so you can often achieve that high-end look with a relatively modest budget, maybe a few $100 for great tile and a quality fixture set, and get a massive perceived value boost.
Interesting. What else?
Another one, maybe the absolute cheapest bang for your buck improvement, is dealing with smells. Bad odors are instant deal killers. If a house smells like old pets or smoke or just musty, buyers run. But maybe 90% of the time, especially in older homes, that smell is trapped in the old carpet and, crucially, the padding underneath, tearing out that old carpet and pad. You might solve the vast majority of the odor issue for literally under $100 in disposal fees and your own labor. Yet it can completely change how someone feels about the property.
Wow, less than $100 to fix something a buyer might mentally knock 10 grand off the price for.
It can be that dramatic. And on the flip side, investors need discipline about tackling deferred maintenance. People sometimes think, oh, I'll just let the next owner fix that broken fence board or that torn window screen or the dripping faucet. But that's a financial illusion. You always pay for deferred maintenance. Always. You either pay for it implicitly, because a smart buyer sees those things and lowers their offer to account for the hassle and unknown cost of repairs, or you pay for it explicitly when it shows up as a required repair item on the inspection report before closing. Fixing those small things up front, usually pretty cheaply, is just part of running a tight, systematic operation.
Right. Execution relies heavily on financing. And as investors want to scale up, they often need to look beyond just getting a standard mortgage. Let's explore some of these less conventional financing routes that can help people grow faster or tackle deals banks wouldn't touch.
Okay, a really useful one, especially if the seller owns the property outright, is owner financing, sometimes called seller carryback. In this scenario, the buyer doesn't go to a bank for a loan. Instead, the seller effectively becomes the bank. They finance the purchase for the buyer, usually holding a note or mortgage on the property.
Okay, that sounds potentially great for the buyer, maybe easier qualifying, potentially flexible terms. But why would a seller want to do that instead of just getting all their cash up front?
There can be significant advantages for the seller, too. First, it can open up their property to more potential buyers who might not qualify for traditional financing. Second, they get a steady stream of income over several years from the loan payments, which can be attractive, especially for retirees. And third, and this is often a big one, there can be major tax benefits. By receiving payments over time, they might be able to structure the sale as an installment sale under IRS rules. This lets them spread out the capital gains tax they owe over the life of the loan instead of taking the full tax hit in the year they sell. That can be a huge saving.
Got it. Okay, what about another tool often used for quick flips or heavy rehabs, hard money loans?
Right. Hard money is a different beast altogether. These are short-term loans, usually from private individuals or specialized companies, designed for situations where speed is critical or the property itself wouldn't qualify for a conventional bank loan. Think a severely distressed property needing major renovation before it's habitable. Hard money lenders think differently than banks. Their primary concern isn't really your credit score or income, it's the asset itself. Specifically, they focus on the property's after-repair value. Because they're lending against that future improved value, they can sometimes be incredibly flexible. If you find a truly amazing deal, say buying a wreck for $100 that you know will be worth $250K after $50 in repairs, a hard money lender might finance not just the $100K purchase, but potentially the $50 rehab costs too, maybe even rolling in closing costs. They might fund 100% or close to it if the deal's underlying value provides enough security for them.
That sounds almost too good to be true. What's the catch? Because there's always a catch, right?
Oh, there's definitely a catch. You're essentially paying a very high price for that speed and flexibility. Hard money is expensive. Interest rates are typically much higher than bank loans. Think 12%, 15%, maybe even 18% or more. Plus, they usually charge significant upfront fees called points, often 3 to 5% of the loan amount, just to originate the loan.
Ouch.
Yeah. So hard money really only makes sense for very short-term projects like a quick flip you plan to sell in 6 months or a BRR deal where you'll refinance into a traditional lower rate loan as soon as the rehab is done and the property is stabilized. You're trading money for time and opportunity. You have to be absolutely certain your numbers work and you can execute quickly.
Okay, shifting gears slightly. Let's talk about taxes. It's often said the tax code seems to favor real estate investing. Why is that, and what are some key benefits investors should know about?
Well, the rationale often given is that providing housing and improving properties is seen as beneficial for the economy, so the tax code offers incentives. One of the biggest and maybe most misunderstood benefits comes from depreciation. The IRS lets you deduct a portion of the cost of the building, importantly not the land value, over a set lifespan, currently 27.5 years for residential rental properties.
And this is a deduction even if you didn't actually spend that money in that year, right? That's why they call it a phantom deduction.
Exactly. It's a non-cash expense on your tax return. Let's make it super simple. Say you buy a rental and the building itself is valued at $275,000. Divide that by 27.5 years, and you get an annual depreciation deduction of $10,000. Now, even if your property is actually cash flowing positively, your rent income exceeds your mortgage, taxes, insurance, and actual repairs, you still get to subtract that $10,000 depreciation expense on paper.
Which lowers your taxable income.
Right. It reduces your taxable income from the property, potentially even creating a paper loss. This passive loss can sometimes offset other passive income or be carried forward. So you could be making money in your bank account, building equity as the loan gets paid down and the property appreciates. Yet on your tax return, it looks like you're breaking even or losing money, significantly reducing your tax bill. This is why getting specialized tax advice is absolutely critical for serious real estate investors.
Okay, and the final piece of this advanced strategy puzzle, especially for investors wanting to trade up and really build wealth over time, is the 1031 exchange.
Ah, yes. Section 1031 of the Internal Revenue Code. This is incredibly powerful. It basically allows an investor to sell an investment property and defer paying capital gains taxes on the profit, provided they reinvest those proceeds into another like-kind investment property within a strict time frame. Like-kind is pretty broad for real estate. You could exchange raw land for an apartment building, for instance.
So it's like that monopoly analogy, trading up your smaller houses for a bigger hotel without having to pay tax on the gains from the houses along the way.
That's a perfect analogy. You keep rolling your equity forward, deferring the tax liability potentially for decades. This allows your capital to compound much faster because you're reinvesting the government's share, the taxes you would have paid, alongside your own money. You only pay the accumulated capital gains tax when you finally sell a property and don't reinvest the proceeds into another like-kind exchange. But, and this is a huge but, the rules are incredibly strict and unforgiving. Once you sell your original property, the relinquished property, the proceeds must be held by a neutral third party called a qualified intermediary. From the date you close that sale, you have exactly 45 calendar days, weekends, and holidays included to formally identify, in writing, the potential replacement properties you intend to buy. You can usually identify up to 3.
Only 45 days. That's tight.
Very tight. And then you have a total of 180 calendar days from the date you close the first sale to actually complete the purchase and close on at least one of those identified replacement properties. Miss either deadline by even one single day, and the entire exchange is blown. All those default capital gains taxes become immediately due. So planning and execution have to be flawless.
Okay, before we circle back for our final thoughts on investing philosophy, we need to address the last section of the source material you provided. This part moves away from real estate specifically and covers broader philosophical and political contexts. As always in this deep dive, we are required to report on the full scope of the provided sources, maintaining strict neutrality and simply conveying the information presented, without endorsing any particular viewpoint.
Correct. The source documents include significant discussion concerning global narratives around recent health crises. Specifically, one perspective presented claims that certain organizations, which the source groups together as the Colgates-Tedros WHO, effectively had their version of events widely promoted, almost like free advertising. Concurrently, this perspective alleges mechanisms were actively used to suppress or censor viewpoints that challenged this dominant narrative.
The source material also makes strong claims about public health policies. It specifically contends that guidance instructing healthy individuals to isolate had severe negative consequences, going so far as to assert that this practice resulted in the deaths of tens of thousands of elderly people, purportedly under the banner of protecting the vulnerable.
Delving further, the source material puts forward some highly technical and frankly speculative claims about biological interactions with technology. It posits the existence of a synthetic substance, allegedly deployed on a large scale, which generates its own electrical voltage and functions akin to an antenna. According to this source, this antenna interacts with electromagnetic frequencies from technologies like 5G, smart devices, and even satellite systems like Elon Musk's Starlink, and then transmits signals outwardly.
And related to these themes, the index topics listed within the source material reference serious concerns around potential DNA manipulation, concepts termed genetic suicide, and specific anxieties about impacts on female infertility. The source also compiles accounts claiming deaths and various illnesses were directly caused by vaccines. Again, our role here is simply to report that these claims and concerns are present in the source material provided for this deep dive, not to validate or refute them.
Shifting to a different historical context covered in the sources, there's a recounting of the journalistic investigation into the Watergate scandal. It details how federal investigators reportedly uncovered information indicating that high-ranking officials within the Committee for the Re-election of the President, known as CRP or CREEP, were directly involved in financing the break-in operation at the Watergate complex.
The material goes on to describe the subsequent cover-up attempts within the Nixon White House. It mentions key aides, specifically H.R. Haldeman and John Ehrlichman, allegedly pressuring White House counsel John Dean to essentially take the fall, to accept full responsibility in order to shield them, and ultimately, President Nixon himself. The source emphasizes Dean's refusal to do so, stating his intention was to directly implicate the president in the obstruction of justice. This highlights the intense internal power struggles and the fight for accountability during that critical period.
Lastly, the source material touches upon a famous case study often used to illustrate the bystander effect in social psychology, the murder of Catherine Kitty Genovese in New York City in 1964. The initial highly influential reporting claimed that some 38 witnesses watched her prolonged and brutal attack over roughly 35 minutes without intervening or even calling the police. This story became a textbook example of diffusion of responsibility in groups.
However, importantly, the source material also acknowledges subsequent research and analysis of the Genovese case. It notes that later investigations identified significant factual inaccuracies, specifically citing 6 errors in the original New York Times article that shaped the public narrative. This later work suggests the initial story, while impactful, may have been, as the source puts it, a bit too heavy on legend. It serves as a useful reminder about the importance of critically re-examining even widely accepted historical or sociological accounts against primary evidence. #outro. Okay, let's bring this all back together. Finding that next great real estate investment, that neighborhood on the cusp, or that undervalued property, it really isn't about guesswork or luck or just following the trendy indicators like coffee shops, is it? It's about meticulously building and following a system that integrates understanding risk, knowing what drives urban growth, using leverage smartly, and taking advantage of the tax code. It seems like the process, the system itself, is what leads to results, not just hoping for a good outcome.
That's absolutely the core message for you, the listener, the learner. You have to shift your focus inward. Concentrate on the things you can control. Your thinking, your analysis, the systems you implement, your investment discipline. Don't just sit back and wait for external factors, the economy to magically get better, the market to turn in your favor, your company to change things to improve your situation. Your greatest leverage point is your own defined process.
We started this discussion grounding ourselves in that fundamental law. Risk and reward are inseparable. So maybe it's fitting we end by applying that defining value. Our whole conversation seems to point towards an interesting conclusion. Perhaps the biggest opportunities, the most significant value in real estate isn't found in booming markets where everyone is optimistic and prices are high, but actually in distressed situations, where risk seems high, but maybe the underlying value is still solid.
That really echoes the Dundho investing philosophy mentioned in the sources. The idea is to specifically look for investments, whether businesses or properties that are currently distressed, where the fundamental risk of losing your capital is actually low, maybe because the purchase price is so cheap, but where the uncertainty surrounding the situation is very high. That uncertainty scares most people away, creating the potential for bargains.
Like that story of Papa Patel back in the 70s. His whole strategy was built around finding distress. Buying that motel for $50,000 with only $5,000 down, That was possible because it was distressed, maybe poorly managed, in an uncertain economic time. The uncertainty was sky high, but because the price was so low relative to the asset's potential, his actual risk was carefully managed.
Exactly. So the final thought we want to leave you with is this. As you analyze markets and look for opportunities, don't just look for the signs of growth. Actively look for signs of distress too. Where are the hidden gems today? Maybe it's properties stuck in probate or tangled in bankruptcy or just suffering from severe deferred maintenance in an otherwise decent area. What situations exist right now where uncertainty is high, scaring off the herd, but a smart investor with a clear system like BRRR could step in, solve the problems, and unlock tremendous hidden value. That's where the real deep value might be hiding in plain sight.